All right, ladies and gentlemen, welcome to the Macro Ace live stream with your host, Tony. Hopefully you can hear me clearly and you can also see my screen clearly. Do let me know if there's anything different, if there's anything you can't see, or any questions that you have, I'll answer them as we go through the prep here. But thank you very much for joining me for today's prep with myself. Quick note before we get ahead. Just wanted to do a bit of promo. Of course, we have Macro Ace. Don't forget you can follow us on Twitter at Macro Ace on here with the link there. Of course, we'll be posting out the list of, and we'll be posting out the videos or live streams on here as well for you to join and watch the live streams with us. Also bearing in mind with Financial Juice, so if you want to get a real-time news, voice and text service to stay up to date with what's going on in the markets and be able to manage your risk or manage your trades in a much better way with all the current issues that are going on globally, with sentiment being affected left, right and center, then this is the place where you can make sure to manage that risk as best as you can. So we have there's a 7-day free trial of Financial Juice Pro, no ads, live real-time voice and text service. You also get access to our news desk as well, and real-time economic release triggers where you can set your figures for if a certain so let's say if the ISM reaches 55.5, then that will set off a little trigger here for you. If the figure matches your trigger, then it will set off saying a sell or a buy. But that's a manual thing that you can add yourselves as well on the Financial Juice news feed. So those are the features that are available. So don't forget to check that out. I'll pop that in the description, the message box here as well. And then Tick Strike is very crucial to listen to, I think, and it has been, because it lets you listen to order flow. If you've been in pit trading, maybe you've listened to when the markets have opened up, all the guys and gals standing there shouting buy, sell, 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 sell. That is what Tick Strike is. Right? It lets you listen to the order flow within the markets. So if you would like to have a go with Tick Strike and find out more information about it, we'll also post that here for you too. So that is there for you. So you can have a little look and review that there. But anyways, that's a bit of that is the advertisements out of the way. Now we get back to the prep. So we've got about 26 minutes till we get the release. Okay, so ISM Manufacturing. And Omar Nomuchi says screen and sound are okay. Great. Good to hear. So what is it? It's the first monthly report on the economy focused on, in the manufacturing sector. And that's done by a group representing purchasing managers around the nation. So what they look at is new orders, prices paid, employment costs, backlog of orders. And the key thing as to why purchasing managers have a lot of sway is because they're in charge of purchasing materials and goods to create the final goods or the intermediate goods. They're the forefront. They see how much it costs, how long it's going to take to deliver the goods, and whether or not if there are enough workers to provide that supply to supply that to meet that demand from the other companies that are buying those goods, and also from consumers as well, whether or not how long it will take and how much it costs for consumers to buy those goods. But that's why purchasing managers are very key very important when looking at how well the economy is doing. And it's also the first report on how the manufacturing sector is within the economy from the from the US government. So it carries a lot of weight in regards to its importance. Usually a pickup in demand means more orders created to meet that demand. So that can be a very positive thing. Sometimes it can be a negative, where if there's too many orders or if there's a big pickup in demand, then it could be a negative, where there's a cause of supply chain issues, where deliveries might be late or prices might need to be raised higher in order to slow down the amount of orders being placed. Fed is also briefed on the data before the public. So again, it's a key release that the Federal Reserve keeps an eye out for as well. And the report represents, as said, the month gone. So and we get the data in the first week of the new month. Of course, that's always going to happen. We get ISM, and we get the ADP data, and we get the non-farm payrolls data as well. So heavy week for US data that carries a lot of weight. So usually above 50 equals an expansion, and anything below that will mean that there is a contraction within the economy. So you may see that one of the things that we'll talk about is China as well, how badly they fared tonight as well. But that's one thing to just be aware of, that if we do get a figure that is still above 50 but is lower than forecast, for an economist and for the economy, that's still good. Okay. For us traders, we're looking for how big that deviation is in order to factor in, or in order to understand whether or not it's enough for us to do anything. But usually above 50 is good for the economy. Anything below 50 is not good for the economy. Okay, so if we carry on, every full point in the ISM Manufacturing Report can add 0.3% to growth over a year. So it's not within a quarter, but with over a year, that's still quite a significant amount for the US economy. But again, that's why it's an important release to keep an eye on. So the previous report, so it was the 22nd consecutive month of growth after contraction in April and May 2020. And the US manufacturing sector remains in a demand-driven, supply chain constrained environment. In March, progress was made to solve the labor shortage problems at all tiers of the supply chain, which will result in improved factory throughput and supply deliveries. That's also another key thing to bear in mind as well with the employment that's going to crop up later. March brought back increasing rates of price expansion due primarily to instability in global energy markets. Of course, that's to do with Ukraine and Russia, causing huge swings in WTI crude oil and Brent and crude oil in general. Suppliers are not waiting to experience the full impacts of price increases before negotiating with their customers. So these manufacturers, of course, they can see the level of prices increasing already. So for the oil that they're using to buy, or that they're buying to transport their goods or make their goods. So what they're forward thinking themselves, that in order to prepare for any loss in revenue because of higher prices, that they will actually increase their own prices to factor that in. And Omicron is still being felt as well. So the CPI report, one thing I also wanted to go through, and the economy, you had energy prices were up a whopping 11% in March versus a prior of 3.5%. Just something to add to the sentiment of high inflation impacting these businesses and also consumers as well. But a lot of that would be from the producers making those goods that would provide, or that would increase the prices that they're providing to consumers for their goods. Also, employment costs is at 1.4% versus a prior of 1.1%. So there's an increase there in again, employment costs. You see, it's going to be more of a regular thing coming through. Scotch and stocks with a triple dab. Thank you very much. Hey, how you doing? Good to see you again. Also, the manufacturing and payrolls that we had recently as well, or last month, we've seen a 38k increase in jobs or net jobs versus the prior of 36k. So, job market still increasing, still seeing some strong increases in jobs being added, particularly in the, of course, in the manufacturing sector as well. That's been quite steady, but it does look to get a bit tighter. So respondents, so for the ISM report, so they said that there's no let-up in supply chain issues, and overall business conditions are challenging in both domestic and international transportation. The invasion of Ukraine has created uncertainty in the grain markets, causing upward pricing pressure. And in addition, inflationary pressures across all categories have made it challenging to manage cost and profitability of key particular areas, so food, beverage, and tobacco products. So again, Ukraine conflict, now that the markets are more or less have pulled away from the sentiment of focusing on the Ukraine crisis, although it is still there in the back of traders' minds, it isn't as prevalent compared to Fed central bank tightening or the lockdown issues in China and the manufacturing issues in China. So the Ukraine-Russia conflict, less of a focal point compared to the other two, but still a focal point for the economy. So the Fed Beige book, what we had seen so this was released April 20th, but the questionnaire was done April 11th. So the US economy grew at a moderate pace through mid-April, but rising prices and geopolitical developments created uncertainty and clouded the outlook for future growth. Inflationary pressures remained strong since the last report, with firms continuing to pass swiftly rising input costs through to customers. And rising costs of supplies is pushing some firms to lift their prices. Again, as we'd seen, as I mentioned earlier on, you had, in the wake of higher energy prices, firms were starting to raise their prices in preparedness for it. So you have a lot of businesses in New York district saying that the input costs were rising for a wide range of supplies and expected to increase further. And a large growing share of businesses plan to increase their selling prices in the months ahead. So nothing unexpected, more so as said to prepare themselves for higher energy costs and supply chain issues, which would cause an increase in the price of goods to make the goods to sell to consumers. And then this is the key focal point, I think, for not only the economy, but also the Federal Reserve as well and other central banks. One thing a central bank doesn't want to happen, or a government or central bank doesn't want to happen, is where inflation is really high and the economy at the same time is recovering from a pandemic where a lot of jobs are being added, okay, but there are not a lot of workers. So what that means, if there are not a lot of workers to meet or to fill those jobs, then that means those businesses will have to raise their wages in order to attract more people to their business. So this is quite a prevalent thing where if there are higher wages, that will add to a pressure to inflation. Of course, the higher wages, the higher the wage that you have, the more that you have to spend. And although you have inflation that is outstripping the wage or yearly average or yearly wage or average weekly earnings in the US and in other nations too, if that's on the rise, then that means that still that will add to inflationary pressures, where they would look to actually push up prices. So that's one risk that the Federal Reserve is keeping an eye on, particularly with a very tight labor market, is what they've been talking about so far. Everyone knows that they're going to tighten, and it's evident with the 50 base point hike expected on Wednesday. But there are other areas that the Federal Reserve is looking to. Scotch and Stock says, "I'm good, sir. Hope the weekend was good for you as well." Yeah, it was good. It was nice and relaxing. Hope it was good for you too. So going back to the presentation then, so you had Cleveland, some areas in the US, particularly in Cleveland, where they're finding it was difficult to find workers, which led to higher wages, but they were still having issues. A lot of it, the reason why there were issues is because of living costs are rising. If energy prices are rising, then your energy costs, then the cost of living is going to rise. If grain or food supplies become more expensive, that's going to make shopping in the supermarket more expensive to buy your bread or your other goods as well. So if we look further ahead, so the rest of the sentiment too. So China, now this is I think this is the kicker in the teeth for the markets to be aware of. And the reason why we've seen a lot of movement towards the downside on WTI crude oil so far. So China, some attention was focused on data from China over the weekend that showed manufacturing activity dropped to a six-month low in April as lockdowns continued in Shanghai and other manufacturing hubs amid COVID-19 outbreaks. So that's pushing sentiment into more of or partly pushing sentiment into a bearish sentiment or a risk-off sentiment. Okay, where you have supply chain issues. If the manufacturing sector in China is not doing well, how soon would it mean, or how soon would it be until we start seeing we start seeing a contraction within other economies as well? So if we look at the particular figures, we had the Chinese Chinese NBS, or the official Chinese release, showing 47.4 versus a prior 49.5. So there was already a decline anyway, or there's already contraction in China, but this was just made worse and added to that negative or bearish sentiment in the crude oil market. So crude oil currently down, from what we can see, about 3% on the day so far. Okay. And then we go back to... All right, so if we carry on, so you had the Fed. So the Fed market pricing overwhelmingly implies expectation of interest rate increase of 0.5 percentage point to a Fed funds target range of 0.75% to 1%. So remember, with the Fed funds target range, usually it's the high end of the range is taken as the new figure for the interest rate. So currently setting up 0.5, then a 50 basis point hike would take it to 1%, and then the new range would be 0.75 to 1%. So if we're looking at the market pricing, then the Fed Watch tool is also, I think, going to be quite key to what. Well, I mean, it's obvious what's going to happen, but just out of curiosity anyway, and just to confirm markets pricing in a 50 basis point hike, near enough 99.8% chance or an expectation of a 50 basis point hike to 1%. And then if we're looking at a 25 basis point hike, there's a 0.2%. Okay, so a month ago, you'd seen that the 25 basis point hike was at 30%, and the 50 basis point hike was at 69.5%. Okay, so again, as said, markets, if they're already pricing it in. If we look at the S&P 500, if we see how it is. So already down on the day, on the futures, or already down on the day, for what we can see over the weekend as well. So if we go to an hourly chart, so if we go back to April 1st, around there, so you can see that the markets, or the S&P 500 and investors have been pricing in a 50 base point hike ever since the previous meeting, and ever since Powell said that the 50 base point hike is on the table as well. So ever since then, we're seeing that market pricing in 50. Now, if we go back to our presentation, so the triggers then, this is what we want to keep an eye on and just understand. So the triggers, so high estimate, that this is according to economists, they're looking for 59. Just bearing in mind, we did get the the S&P Manufacturing PMI final report, or the market manufacturing data, and that came in at 59.2, lower than forecast of 59.7. Reminder, that's not official government data. That is from a private firm. So just to bear that in mind when we're considering looking at what the S&P, or we're looking at what the ISM could be in about 8 minutes time. But just again, looking to economists' point of view then, so they see 59, a high of 59, and with the low estimate of 56. A reminder, so the ISM Manufacturing PMI, we're looking for a median forecast of 57.6 with a prior 57.1. You've also got other areas to focus on too for the ISM report. You've got so you've got that prices paid with a forecast of 87.4, the prior of 87.1, and the employment index forecast of 55 with a prior 56.3. So from investment banks, TD Securities sees 57 for the ISM report, JP Morgan 58.5, and ABN AMRO 58. Now the market reaction was muted on April 1st. Even though we had a deviation of about 1.9 in the figure, there wasn't any reaction to it. So whereas with the previous report that we had on March 1st, we'd seen with a 0.5 deviation, we'd seen about a 40 tick move towards the upside on the S&P. Dollar yen seen about 5 pips up. 2-year that's seen about 7 ticks down, and 30-year about 3 ticks down. And then gold had seen about 31 ticks down as well. So from what I'm basing it on, what we're expecting for today, I think, as said, if the markets have already priced in a 50 basis point hike for Wednesday, that's not going to be there. So that, I think anything to do with the ISM, I think we might see some more of a positive reaction. The reason being is markets have made their mind up what's going to happen on Wednesday. So now they're looking for more. They may be looking for more positive data. Hence, back on March 1st, we'd seen initially if I bring up the prior release for you. March 1st, we'd seen that there wasn't. There was more of a positive reaction after the initial candle. And then we'd seen that positive move towards the upside. So I think the manufacturing sector I think traders are looking for a better than expected figure or blowout figure in order for them to try and jump on. And also, as said, if I've already mentioned, but if traders have already made up their mind, then if the Federal Reserve has already made up their mind, the ISM isn't going to change that too much or at all, really. Just trying to get the other ISM for you. So this is a recent ISM report. We've got about 5 minutes until the release. Okay, let's go back. Okay. Right. Okay, so about 4 seconds to the release. We've got eyes on the dollar yen, the S&P, and also gold as well. Okay, so it was worse than expected. Seen a little bit of a movement towards the downside on the dollar yen and also on the S&P 500 off of that release. Gold has seen a little bump towards the upside, but I think now these, as I said, these releases, there's a little bit more of a correlation between these releases when we're looking at the dollar and the S&P 500. Whereas now, if there's any, and if we're looking at inflationary reads, that usually is going to favor the dollar more so than the S&P 500, as that's going to lead to a stronger rate hike, maybe. Whereas if we're looking at the manufacturing sector, where a lot of businesses, how well businesses are doing, then that could be a factor that could support the S&P 500 or the stock market. So I think that's something to be aware of, that we may see if we do get a more, let's say, a very positive figure from the ISM report, we could see a positive reaction from the S&P 500 rather than a negative one, and vice versa. If we do get a really negative figure, we could see a negative reaction from the S&P 500 as well. But again, that's something just to be aware of. As said, from what we'd seen on March 1st, where there was more of a positive reaction to the data, because the figure was better than expected. Okay, all right. So we've got about 2 minutes until we get the release, or less than 2 minutes till we get the release. But again, there was no real reaction there. Again, we did see a bit of a move towards the downside on the S&P 500, and a similar reaction on dollar yen. Didn't really see too much reaction either. It's just dead. Okay. Right. Well, that is that. Let's close that. Let's go to our charts. Right, a minute to go. So I think for ourselves, I think today will be from previously. The previous report didn't get any reaction with a point, with a nearly a 2-point deviation. So I think we'll be looking for about a 3-point deviation to get any sort of positive or any sort of movement on the S&P and also the dollar yen. We get up gold as well. Got something there. It's tick strike running. Background. Let's get gold. 10 seconds. All right. Less than 10 seconds now. Okay, figures already come out. 55.4, lower than the forecast of 57.6. Dollar yen seems to move towards the downside. Gold did see a little bit of a pop. S&P also seeing some movement towards the downside as well. So, okay, that's confirmed what I was expecting then. That the stock market will also see a bit of a movement towards the downside. So it's, again, much worse than expected. If we're looking at our deviations, looking at our other charts. So initial move towards the downside there on the S&P 500. just to erase that move. So there was a low estimate of 56. So that was worse than the low estimate of what economists were expecting. And that, if I just double check. So the median survey, and that was right. So that's about a 2.2 deviation there on the figure. All right, so I think the market's coming back into a little bit where we're actually seeing a bit more of a reaction to the release. Dollar yen still down. S&P. So let's get to some measuring some of these releases then. See how many pips. Alrighty. It's about 19 pips there. If I can get that. So 19 pip move towards the downside on the dollar yen. And then the S&P, what I want to factor in, I think, of course, there was that initial move towards the downside. So if I go from there, so that's where the candle started. Let's see, so we've seen about 32 ticks towards the downside first. And then we saw a reversal of that figure to where it's seen about 32 ticks towards the upside as well. So overall, there was, again, initial drop and then a reversal of that to end that candle in the green. Okay, also gold. Gold didn't really see too much reaction, to be honest. To be fair, it did see a little pop towards the upside, so I think still worth taking a measure. So about 14 ticks. All right. So 14. Okay. Who traded the release? Just want to find out if anyone did, or were you just kind of sitting and watching, or sitting back and watching? What was going on? Also, that was slightly earlier than expected. Scotch and Stocks saying just watching the results. Okay. Fair enough. Let's keep looking at the results then. Also, I want to look at the NQ, see what happened there, because that was one I didn't have a look at last time, so we need to keep that in mind too. Still not really confident to trade the data. Fair enough. Whatever you're comfortable, then it is all in your own time. Yeah, never ever trade when you're not comfortable. Right, so NQ. So initially, it's about 183 ticks down. And then we'd seen similar. It probably just made us. Probably made about 80 ticks back towards the upside. So what it looks like there. Probably is. Whoa. Yeah. Right. Let's look at the bonds. ZT 2-year. All right, that's a bit of a nice movement from what I can see. bond prices going up with more of a risk off sentiment, leading to people jumping into, or traders jumping into bonds. If there is a contraction, if we're going towards a contraction, so that was about 11. Whoops. 11 ticks towards the upside. That was much better than much stronger than the reaction that we had seen on March 1st, where we'd seen about 7 ticks down. So 7 ticks up. And then the 30-year, or ZB, probably get about 6. Maybe about 5, I think. Maybe less. But still, bond prices overall, I think, are going to go up. There, 6. All right, 6 ticks up. All right. Well, although we can't discount that there was can't discount that there was some movement towards the downside too. So there's a bit more of a whipsawing, and then up we go. Bond price going up, and then I think finally want to look at the other currencies too. GBP/USD cable. So what you did, probably a nice move up. Okay. Interesting. Oh, no. Yep. There we go. I nearly misread all of this movement as the initial movement. Okay. So, a bit of a move towards the upside. 9 pips towards the upside there. So more so the dollar yen had the bigger reaction so far, currency wise. And then the euro dollar. Right. So we got a bigger reaction. Okay, probably about 10, 12, 9. Okay. So similarly same then. About 9.5 pips. Let me just double check. Cable 9.4. Yeah. 9. USD CAD. Yeah. Okay, it's about 10 pips there on dollar CAD. Okay, so 10 pips up on, 10 pips down, dollar CAD. All right. Euro dollar is heading lower. Yeah, now we can see. So it was more of a flash in a way. It was so far we've had a stronger reaction from the dollar yen compared to all the other currency pairs so far. And then also we have we're looking at the S&P and the Nasdaq. What this release confirmed for us is that there was, from that initial move towards the downside, there was, or the worst unexpected data, there was an initial movement towards the downside in the stock market too, or on the stock indexes too, the S&P 500 and also on the Nasdaq as well. So the central bank, or the idea of the central bank pricing, or the idea of markets pricing in a 50 basis point hike into the markets. As said, near enough 100%. Now the focus is on how well the economy is doing. That's what we can see. Well, that's what the release today, or the reaction to me, confirmed. Alrighty. Ooh, let's see. So Galaxy wants, hey, Galaxy One. Do you know what triggered the Euro Aussie dollar last Friday to go up so high? Last Friday. If we're thinking last Friday. Let me double check that for you. Euro dollar. That's got to be quite a bit specific. I'll check that for you. If you email me, Tony at financialjuice.com, and then I'll ping you an email over. Update to everything says the biggest move today would be Aussie dollar cash rate today at 11:30 Central Time. Yeah, so I think of course. So if we're talking about the other bits of news, so there is a 25 base point hike expected from the RBA, which would be the first in quite a while for the RBA. So again, markets looking to price it in. From that's going to be mostly the reason why, as to it went up last Friday. But also, I'm thinking in particular Euro news that's linked to the Aussie dollar. If we're thinking about the Euro dollar, it's okay, Galaxy One, you don't need to email me now. That's of course we have our rate decision tonight with the RBA, so it's more pricing in of the RBA that's led to the euro weakening. The ECB itself hasn't hiked its rates yet, so it's more of a lagging behind the other central banks. So hence the euro dollar would have seen some weakening on the Friday. But as I said, I can look into further for you for more information as well in regards to the euro dollar. Okay, ladies and gentlemen, thank you very much for watching. I hope you found this useful. If you did, don't forget to like and share this video, and also subscribe to the channel as well for the Financial Juice YouTube channel to stay up to date with the other economic releases that we'll be providing for you this week. As said, it's going to be very, very busy. We're going to have a lot of, of course, we have a lot of big releases with the FOMC, with Bank of England rate decision, and then also non-farm payrolls for Friday. So it's going to be a busy week, but if you did find it useful, don't forget to do that. And also the other links above too. Macro Ace to join, to follow us on Twitter, and also to have a free trial, or 7-day free trial of FJ Pro, or the Financial Juice news stream. So you can see the news did come out earlier slightly earlier, and it was quick and instant on the site. And then we'd seen that reaction in the markets. So don't forget to have a little try of that if that's something that would be useful to you as well. And also Tick Strike, of course, what we've been looking at all the time today, what's been on our screens. Then do have a look at that if you want to listen to order flow and stay up to date with what traders are feeling at the moment. So at the moment, we got the NQ. So still showing a lot of, still showing some sell orders coming through, and the ES similarly as well. Gold, that's a doozy. It didn't really do anything. All right. Thank you very much, ladies and gentlemen. I will catch you on Wednesday with the EIA inventories and FOMC. Thank you very much, and good night. Oh, good night. Good day.